Everyone has the brain power to make money in stocks. These are 3 Warren Buffett's rules that will make you money on the stock market. Rule 1. Behind every stock is a company. Find out what it's doing.
A stock is part of a business. I mean, you can't think of a stock as something different. You value a business, and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's its management like, all of these things that relate to a business instead of a little ticker symbol. I used to know when I was 11 or 12 the ticker symbols of every company virtually on the New York Stock Exchange. I could mark the boards at Harris Upham, but I didn't know anything. I mean, I knew that X was U.S. Steel and T was AT&T and so on, but I didn't know anything. I didn't know what was behind them. So I had to start looking at these little symbols or these little names in the paper as businesses and decide, how do you value a business? What counts?
Second rule, invest only in companies you understand.
I like businesses I can understand. We'll start with that. That narrows it down about 90%. I mean, there's all kinds of things I don't understand, but fortunately, there's enough I do understand. And you got this big, wide world out there. Almost every company's publicly owned, so you got all American business practically available to you. Now, to start with, it doesn't make sense to go with things that you think you can understand, but you can understand some things. I can understand this. I mean, you can understand this. Anybody can understand this. I mean, this is a product that basically hasn't been changed much. They've added the cherry, but since 1886 or whatever it was, and it's a simple business. It's not an easy business. I don't want a business that's easy for competitors. So I want a business with a moat around it. I want a very valuable castle in the middle, and then I want the duke who's in charge of that castle to be honest and hardworking and able. And then I want a big moat around the castle, and that moat can be various things. The moat in a business like our auto insurance business at Geico is low cost. I mean, people have to buy auto insurance, so everybody's going to have one auto insurance policy per car, basically, or per driver. And I can't sell them 20, but they have to buy one. What are they going to buy it on? They're going to buy it based on service and cost. Most people will assume the service is fairly identical among companies or close enough, so they're going to do it on cost. So I got to be the low-cost producer. That's my moat. To the extent my costs get further lower than the other guy, I've thrown a couple of sharks into the moat. But all the time, if you've got a wonderful castle, there are people out there who are going to try and attack it and take it away from you. And I want a castle that I can understand, but I want a castle with a moat around it. 30 years ago, Eastman Kodak's moat was just as wide as Coca-Cola's moat. I mean, if you were going to take a picture of your 6-month-old baby, and you're going to want to look at that picture 20 years from now, and you're going to want to look at it 50 years from now, and you're never going to get a chance. I mean, you're not a professional photographer so that you can evaluate what's going to look good 20 or 50 years ago. What is in your mind about that photography company is what counts, because they are promising you that the picture you take today is going to be terrific to look at 20 or 30 or 50 years from now about something that's very important to you, maybe your own child or whatever it may be. Well, Kodak had that in spades 30 years ago. They owned that. They had what I call share of mind. Forget about share of market, share of mind. They had something in everybody's mind around the country, around the world, with a little yellow box and everything, that said Kodak is the best. That's priceless. They've lost some of that. They haven't lost it all, and not due to George Fisher, who runs it. George is doing a great job. But they let that moat narrow. They let Fuji come and start narrowing the moat in various ways. They let them get into the Olympics and take away that special aspect that only Kodak was fit to photograph the Olympics. So Fuji gets there, and immediately in people's minds, Fuji becomes more at a parity with Kodak. You haven't seen that with Coke. Coke's moat is wider now than it was 30 years ago. You can't see the moat day by day, but every time the infrastructure gets built in some country that isn't yet profitable for Coke, but will be 20 years from now, the moat is widening a little bit. Things are all the time changing that moat in one direction or another. 10 years from now, you can see the difference. Our managers of the businesses we run, I've got one message to them, which is to widen the moat. And we want to throw crocodiles and sharks and everything else, gators, I guess, into the moat to keep away competitors. And that comes about through service. It comes about through quality of product. It comes about through cost. It comes about sometimes through patents. It comes about through real estate location. So that's the business I'm looking for. Now, what kind of businesses am I going to find like that? Well, I'm going to find them in simple products, because I'm not going to be able to figure out what the moat's going to look like for Oracle or Lotus or Microsoft 10 years from now. I mean, Gates is the best businessman I've ever run into, and they've got a hell of a position, but I really don't know what that business is going to look like 10 years from now. And I certainly don't know what his competitors' businesses are going to look like 10 years from now. Now, I'll name one I don't own. I know what the chewing gum business is going to look like from 10 years from now. I mean, the internet is not going to change how we chew gum. And nothing much else is going to change how we chew gum. And then are there going to be lots of new products? Is it really, our spearmint and juicy fruit and all those going to evaporate? So it isn't going to happen. You give me $1 billion and tell me to go in the chewing gum business and try and make a real dent in Wrigley's, I can't do it. And that's the way I think about business. I say to myself, give me $1 billion and how much can I hurt the guy? Give me $10 billion. Give me $10 billion and how much can I hurt Coca-Cola around the world? I can't do it. Well, those are good businesses. Now give me some money and tell me to hurt somebody in some other fields and I can figure out how to do it. So I want a simple business, easy to understand, great economics now, honest and able management, and then I can see about, in a general way, where they're going to be 10 years from now. And if I can't see where they're going to be 10 years from now, I don't want to buy it. Basically, I don't want to buy any stock where if they close the New York Stock Exchange tomorrow for 5 years, I won't be happy owning it. I buy a farm and I don't get a quote on it for 5 years, and I'm happy if the farm does okay. I buy an apartment house, don't get a quote on it for 5 years, I'm happy if the apartment house produces the returns that I expect. But people buy a stock and they look at the price the next morning and they decide whether they're doing well or not doing well. It's crazy because they're buying a piece of a business. That's what Graham, the most fundamental part of what he taught me. You're not buying a stock, you're buying a part ownership in a business. You will do well if the business does well and if you didn't pay a totally silly price. And that's what it's all about.
Third rule, use stock market fluctuations to your advantage.
Graham gives you a marvelous set point in terms of how the investor should react to stock market fluctuations. He talks about his mythical Mr. Market in Chapter 8. And there's been no better thing written in terms of the investor's attitude toward stock prices. Most people react the wrong way to stock prices. I mean, they feel good when their stocks go up, they feel bad when they go down. They think the stock market is there to instruct them. And Mr. Market is this partner you have in investing. He's a remarkably obliging partner. This guy comes around every day and he tells you what he'll pay you for your interest in the business or what he'll sell you more at the same price. Nobody ever does that in private business. If you and I owned a gas station together and I said every day I want you to come in and offer me your half interest in the station, and I can either buy your half or sell you my half at the same price, and you have to come in every day and do it, you'd be at a terrible disadvantage. And you'd be at a particular disadvantage if you're Mr. Market in the market, because Mr. Market, our friend in the market who obligingly gives you those figures every day, different figures at the end of the day and the start of the day, but he's naming a price at which you'll either buy or sell. The beautiful thing about him is that this guy is an alcoholic manic depressive. I mean, he is as unsound as they come. He wanders around all day, and looks at the crazy things, and he's going to name all kinds of crazy prices. And you don't have to pay any attention to him, except when it's to your advantage to do so. If that's once a year, if it's once every 5 years, it's one stock out of 3,000. All you have to do is sit there. You have no moral responsibility to this jerk. He is naming these numbers. You didn't ask him to, but he's doing it. And all you have to do is pick the one time when he is particularly depressed or particularly manic or particularly drunk or whatever it may be. And the market will be all of those things. And you take advantage of it. And that's what's remarkable about stocks, if you think about it, is that if you look at the high and low on all of these American companies for the last year, you'll see case after case after case where the high is twice the low. Now that's for a sound American business, is running along, paying people, selling goods, and so on. If you go out and look at farmland 10 miles from here, there's no way in the world over a year that the farmland is going to range in value from X to 2X. It maybe go from X to 110% of X or vice versa. If you look at an apartment house near here and figures on essentially apartment houses like that over a year, it won't move 10% in a given year. But here are the finest of American businesses, and people just name these numbers that go all over the place. And you don't have to play, except when you want to. That's the important thing, and that's what Graham tells you. The market isn't there to instruct you, to tell you anything. The market is there just basically to serve you when you want it to serve you. One of the most important things to remember in stocks, very hard to do, but people have all these feelings about it. The stock doesn't know you own it. You're sitting there with these certificates for Berkshire. The company doesn't even know you own it, and the stock doesn't. It's trading now, and they don't know you own it. So it has no feelings about you. You've got all these feelings about it. but it's just part of a business. If Berkshire is worth 75,000 times 1.5 million shares, roughly 110 billion or something like that, it's a good investment. If it isn't, it's a lousy investment. And you have to value the business. And Graham, it's amazing, but people don't do that in Wall Street. You hear price targets or that kind of thing, but you'd see no one write a paper that says, here is the nature of this business over the next 20 years. What should that business sell for? Forget about what it's selling for. In fact, one of the things I always like to do when I'm looking at investments is I like to look at them without knowing the price. Because if you see the price, it automatically has some influence on you. If you just sit down with the reports, if I get an idea about looking up a company and I get the 10Ks and so on, I would rather not know the price because I'd rather value it without knowing the price.